Talks. I'm Cathy Yang, your intel on the Philippine markets and the economy. In the headlines, hopes on high as trade talks between the Philippines and the U.S. resume in Washington, D.C. Melissa Lopez, chief economist for ASEAN at Lung Green's Capital, joins us live. A more assertive and self-reliant trade strategy is called for, says Ibon Foundation. We speak with Executive Director Sunny Africa. And Bitcoin soars past 120,000 US dollars as the US begins Crypto Week. U.S. President Donald Trump is threatening to impose tariffs on Russia if a deal to end war in Ukraine is not reached within 50 days. Trump made this statement during a meeting with NATO Secretary General Mark Rutte at the White House. He warned of, quote, very severe secondary tariffs, which would also target Russia's trading partners to further isolate Moscow in the global economy. Trump and Rutte also discussed a plan for European allies to buy U.S. weapons and send them to Ukraine, a deal worth billions and billions, according to Trump. Despite his past friendly ties with Russian President Vladimir Putin, Trump's tone has shifted. At the same time, he recently called Ukrainian President Volodymyr Zelensky a dictator without elections, but has also slammed Putin for relentless strikes in Kiev. In May, Trump said Putin has gone absolutely crazy as civilian attacks continued.
And I'm disappointed in President Putin because I thought we would have had a deal 2 months ago, but it doesn't seem to get there. So based on that, we're going to be doing secondary tariffs if we don't have a deal in 50 days. It's very simple. And they'll be at 100%. And that's the way it is. That can be more simple. It's just the way it is. I hope we don't have to do it.
The Philippines is now Taiwanese firms' quote, a top priority, according to analysts. Christy Xu of Chunghwa Institution for Economic Research also said the Philippines is now back on the radar on Taiwanese firms. This, she said, is due to the Philippines' relatively lower tariff across Asia-Pacific. Taiwanese Foreign Deputy Minister Francois Chi-Chung-woo said they are already working on high-level projects with the country. U.S. President Trump announced recently raising the tariff on Philippine goods entering the U.S. to 20% from 17%. And U.S. President Trump's 20% tariff rate against the Philippines has stirred up the prospect of even slower growth. Still, electronics exports, which bear the brunt of Trump's tariffs, account for 25% of the whole economy. Domestic demand still accounts for 75% of the economy, the primary driver of growth. Here's my report. Integrated circuits churned out from these factory floors in Laguna go into piecing up some of the electric vehicles plying America's streets. While integrated circuits shipped out to the U.S. are exempt from tariffs, electronics manufacturing services are not.
I thought we might hit, as you said, the 2023 levels of 46 billion. But, you know, as you pointed out, this tariff developments have been disappointing.
So disappointing had been the bump up in the tariff rate from 17% to 20% that CP is close to abandoning its year-end target. But not just yet.
Our team is really fighting for, of course, all our exporters, and we really hope to get the job done. Everything, of course, is on the table. Any FTA is always good for the country, especially because it will really encourage and it will really strengthen the trade between, of course, the U.S. and the Philippines.
Trade Secretary Chris Roque returns to the negotiating table in Washington, D.C. this week with Presidential Advisor on Investment and Economic Affairs Frederick Go. President Bongbong Marcos flies to the U.S. on July 20. This would be his fourth visit to the U.S. since he began his presidency.
My feeling is we shouldn't be offering any more to them in terms of trade or benefits to the U.S. because I'm not so sure what we still can offer. We know very well that most of the negotiations probably are not really based on tariff or trade uh, differentials, but basically, I think on geopolitics.
As the uncertainty prevails, market players are keeping risk appetites in perspective.
No, I mean, if you look at the tariffs, I know it's bad, but then again, it's not really a big chunk of the GDP.
Even then, the prospect of slower growth here, fueled by President Trump's tariffs, is keeping everyone on edge. Says the Philippines can't afford to follow Vietnam's route, committing to remove tariffs on U.S. goods. With us now is Melissa Lopez, Chief Economist for ASEAN at Lundgren's Capital. Good to see you again, Mel. Welcome back to the program.
Thanks for having us, Cathy.
Okay, so you're recommending the negotiating team to offer opening up our market to U.S. goods. Why?
Well, we have more to lose on both ends, more than exports more than imports. So exports, U.S. is really our biggest export destination. So a lot of our manufactured goods, particularly electronics, which is our biggest product, really goes to the U.S. So we have a lot to lose. Our exporters have a lot to lose if they get slapped a 20% duty. Meanwhile, on the other side of it is imports. U.S. imports do account for just 6% of total imports in the country. And actually, in terms of value, it's less than 2% of GDP. So even if we let go of the tariffs that we impose on U.S. goods, there is room to accommodate that just so our exporters don't have to suffer more, Cathy.
Yeah, but don't we have more to lose if we're talking about opening up the agricultural sector? I mean, I've just spoken with PCCI Sergio Ortiz-Luis, and he said the agriculture sector cannot afford to do so anymore.
Well, a relaxation in tariffs would have to come with corresponding domestic efforts to support our local producers. Of course, it has always been the call, right? But this, more than ever, should trigger a strong response as far as supporting the competitiveness of local industries, especially of our farmers.
Right, and speaking of farmers, well, Jonas Ravelas of Reyes Tacandong has this view that if we open up for wheat and soybeans, that's going to be good because they're primarily used in feeds. So we got to be selective. Wouldn't you agree?
Right. At the same time, our local capacity should be able to match both quantity and quality. So that's the question as well. We do prefer, of course, local production when possible, but at the same time, if we do have to make some concessions to escape that 20%, really high 20% tariff that they want to impose on our goods. So if that's what it takes, we should match this relaxation of our duties with a corresponding capacity building, or maybe, of course, government is allergic to subsidies, but yeah, that would be, it has to come side by side.
Allergic to subsidies, that's kind of a light way of putting it. But yeah, because if we let go of the agricultural sector, then that has an impact on inflation and then the purchasing powers of people. So just taking that into context, how might whatever's agreed upon on or before August 1st influence the Monetary Board's decision policy on August 18th? Because we're keeping an eye on that. And on the level of inflation we're at, still benign at 59-month lows, but could change because of what happens in the negotiations.
Mm-hmm. Well, as far as imports, if we do let in more imports from the U.S. at cheaper or maybe zero tariff, depending on what comes out of the negotiations, it will actually somehow ease inflation concerns. And actually, we're at a low 1.4% last month. So there is more room for the BSP to consider more rate cuts. We're seeing at least one, at most two rate cuts of 25 basis points each for the rest of the year. So we are seeing that growth has been strong, domestic growth has been strong, but there's room to support it further by lowering interest rates.
How much of a limiting or supporting factor is whatever the FOMC does at the end of this month, given inflation figures are out later tonight and the resilience and jobs that we've seen last week? How will the Bangko Sentral ultimately decide when it considers what the FOMC will do?
Mm-hmm. We do uh, see that the Fed will not cut this year. I think that will more bullish than the rest of other investment houses. But regarding the BSP, our domestic conditions are performing better than how the US is unfolding. We did manage a 5.4% growth in the first quarter against a contraction in the US. So in terms of relying on the FOMC for cues, there is more space here to cut relative to the Fed, although, of course, they will remain watchful about the effects of high interest rates in the US.
Well, let's take a look at your portfolio, because since the last time you were here, it was different. Now you've changed your risk rating towards the US from overweight to neutral. What triggered that? And what do you think is going to compel you to change that again in the remaining months of this year?
Right. So we actually changed last April from overweight to neutral. Overweight has been our rating since 2022. So about 3 years overweight towards the US. But really, we find the US assets less attractive due to the very high volatility caused by the trade war. We find that Trump's trade war has hurt the US economy the most, even more than its targets like China. And that makes this uncertainty really makes us concerned about the returns that investors could realize from investing in the US. And our allocation instead is to add more alternative investments to our portfolio towards Europe, but selectively. So we prefer adding more alternative investments to our portfolio, and that means acquiring shares in non-listed high growth startups in Europe. So that's where we're going towards, Cathy.
Right. It's so interesting because it's so nuanced. It's non-listed high growth firms and in Europe, and the defense companies or those invested in defense. What impact would that have, though, in your Asian investments and as a sub-region, the ASEAN, where the Philippines is?
Not defense towards this part of the world, but still high growth sectors. So we do prefer new energy investments. So that's tech, high tech,
Okay.
and AI support regarding software as well as the production.
Got that. So that's tech, IT, and software. And apologies, we've had a little bit of a hiccup in the connection there, but I'm so glad to get your insights. Melissa Lopez, Chief Economist for ASEAN at Lund Green's Capital. And you're watching Money Talks. Coming right up, the net income of the Philippine Stock Exchange rises by 25% from last year. And Sunny Africa of Ibon Foundation talks about the higher tariff imposed on the Philippines as being a self-reliant trade strategy. Welcome back to Money Talks. I'm Cathy Yang. U.S. markets climbed Monday, even after Trump threatened high tariffs to more countries over the weekend. The Dow rose by 0.2%, S&P 500 over 0.1%, and the Nasdaq up by nearly 0.3%. U.S. 10-year Treasury yields inched up to 4.426%. Gold prices edged lower to $3,351 per troy ounce after hitting a three-week high as focus turned to trade talks and U.S. economic data. As for U.S. futures, they're pointing to a decline when the markets open later tonight Manila time. The Dow, S&P, and Nasdaq all down by over 0.1%. Asian markets are off to a mixed start in the first hours of trading. The ASX 200 up by about 0.3%, Kospi down by 0.2%, along with the Nikkei 225 down nearly 0.3%. And Bitcoin surged to a new record past $120,000 as investors eye potential policy wins for the crypto industry in the U.S., which has been dubbed Crypto Week by U.S. Republicans. The world's biggest cryptocurrency peaked at over $123,000 before settling near $119,000. Bitcoin is now up more than 27% this year. U.S. lawmakers are set to debate several crypto-related bills this week, a move that's sparking hope for clearer rules. Republicans call this Crypto Week, with bills like the Genius Act set to define federal rules for stablecoins. The rallies boosted other coins like Ether and XRP and pushed the crypto market's total value to nearly $4 trillion. That's even as Trump's chaotic tariff policies have knocked sentiment in other markets. Let's get a quick check on the Philippine market, see how they're doing. PSEI opening today, Tuesday, slightly higher by nearly 0.1% there at 6,529. The stock market rose yesterday, Monday, ending the session higher by over 1%. The broader All Shares Index is up, and the all sectoral indices are in the green, with mining and oil leading gains. As for the Philippine peso, it opens this Tuesday slightly weaker at 56.70 to the dollar. Peso closed slightly weaker yesterday, Monday, 56.63 against the greenback. And the 10-year government bond yields have slightly risen up at 6.253% from the previous close at 6.246. The net income of the Philippine Stock Exchange rose by 25% from last year to almost 500 million pesos. This is after the PSE took full control of the Philippine Dealing System, or PDS Holdings, last April. In their regulatory filing on Monday, the PSE said their operating revenue also rose by 82%. However, their growth was partially offset by a 70% increase in total expenses. A 58% decline in other income was also seen due to foreign exchange losses. That's driven by prevailing market volatility and interest expense from payable loans. The Board of Investments is evaluating 30 manufacturing projects worth over 33 billion pesos, expected to create nearly 1,700 jobs. The projects are undergoing BOI's checklisting phase, where documents are reviewed for completeness and eligibility. From January to June, the BOI has already approved 14 manufacturing projects costing over 26 billion pesos, a 165% increase compared to last year. These approved projects are seen to generate over 5,700 jobs. Trade Secretary Cristina Roque said rising industrial output and strong investor confidence are driving job creation. Philippine manufacturing output grew 4.9% in May, the fastest pace in 10 months. Meanwhile, the Philippines Purchasing Managers Index also rose to 50.7 in June, signaling improved sector activity. On with our tariff theme, our next guest views America's 20% tariff rate on the Philippines as a signal for a more assertive and self-reliant trade strategy. With us now for more is Sunny Africa, the Executive Director of think tank Ibon Foundation. So good to see you again, Sunny. Welcome back to the program.
Hi, morning, Cathy. How are you doing?
Good, thanks. So how should our trade negotiators then re-engage when they go to D.C.?
Well, I think they're off to a wrong foot. They started off on the wrong foot by saying that everything's on the table, including a new free trade agreement. I think that comes from a misunderstanding of how bad free trade agreements have been for the Philippines over the last, maybe 20, 30 years. So I think the best posture would have been starting off from a position that the Philippines is not, just accepting U.S. tariffs. The U.S. will be asserting its sovereignty. In particular, the Philippines is not going to just accept what the U.S. is pushing. I think the important thing that the Philippine government should have been done from the very start, say that that tariffs are unacceptable, they are discriminatory against the Philippines, and the Philippines will be asserting its sovereignty to pursue a more protectionist industrial policy.
But we're not at the start here. We're nearing the end, Sunny. How much of a leverage have we lost?
Unfortunately, we've lost a lot of leverage already by that statement by Secretaries Go and Roque that all things are on the table, including a free trade agreement. I think the Philippines will always have limited leverage if it confines itself to existing unequal trade relations with the U.S. Maybe the better posture would have been getting real leverage from asserting the national interest, building alliances with other countries, for instance, Southeast Asia, instead of giving up even before the negotiations start, instead of giving up what little we have. And I think that, honestly, that idea that they're telegraphing that all things are on the table and that we're keen on an FTA and that we're willing to open up completely to the U.S., I think that goes against the national interest. And in particular, that goes against the Philippine experience. We have had about a dozen FTAs, apart from the World Trade Organization agreements since the 1990s. These have caused Philippine industry to fall to its smallest share of the economy in 75 years. And I think that attitude, I think, should be corrected. We need a much more broader, more complete understanding of trade rather than the narrow textbook notion of comparative advantage.
All right, so what's the low-hanging fruit here? I mean, we've got those free trade agreements, and as you say, they're not working for us, but we can. Presuming that we do still have the time and have the leverage, we should. But how?
Yeah. The danger in trying to seek the low-hanging fruits is that will bias towards looking for tariff cuts because of any short-term export gains. But exactly the problem is the low-hanging fruit might hide the fact that the trade-off for the low-hanging fruit, again, lower tariffs on whatever we're exporting right now, Coach handbags or fruit juices or coconut oil, if the trade-off is constraining the Philippines from pursuing industrialization policy, the long-term costs are really offsetting the short-term gains from the low-hanging fruit. And I think that's so important to start from that perspective, because the really low-hanging fruit should be we are able, especially with the Philippine president going to the U.S. In a couple of weeks, we are actually in a position to assert publicly that we are taking on a more assertive trade posture. I think that is the low-hanging fruit, because the Philippines can start with President Marcos's trip next week. He can sort of, undertake a months-long campaign until the ASEAN chairmanship next year for the ASEAN to stand up to the U.S.'s bullying.
Speaking of the ASEAN, prior to 20%, we were talking about the potential trade diversion. Is the prospect of that trade diversion to the Philippines now all gone? With Vietnam's 46% coming down to 20%, matching ours, which went up from 17%.
Actually, we noticed that the Vietnam deal that Trump has announced doesn't seem to be final yet. There's no formal paperwork about the supposed cut of 26 percentage points by Vietnam. I know Vietnam, I've heard from some friends, some diplomat friends, they're pushing back against some of the non-economic impositions that the U.S. government is asking. And apparently, that announcement by Trump that there's a deal with Vietnam for the lowering from 46 to 20%, apparently that's not been formalized yet with Vietnam. Having said that, I think trade diversion benefits will always be difficult for the Philippines, precisely because we have not actually created the industrial base to benefit from any sort of trade diversion. It's easy to talk about in general terms, climb the value chain, take advantage of diversifying our opportunities, take advantage of trade diversion. But if over the last 40 years, we've limited our industrial base to what foreigners want to put here, that actually limits our capacity to benefit from any sort of trade diversion.
Yeah, lots of variables there throughout many decades past, and not only now, but one constant had been the consumer base, the local purchasing power, and how that's holding up so far at the level of inflation we're on at 59-month lows. Could that be a silver lining as the trade talks continue?
Actually, that's an excellent point. We have to remember the main weapon, the main leverage Trump has in using his, super blunt hyper tariff policy is the fact that the U.S. accounts for about 35% of the global consumer market. I think that's exactly where the Philippines should be taking its lead. We will have more leverage talking to anyone, including the U.S., if we actually had stronger purchasing power and the bigger domestic markets from that. Because again, the US does want to sell stuff to the rest of the world, including the Philippines. So I think right now, one low-hanging fruit, if we're talking about that, one thing the Philippine government can do, expand the domestic market with high wages and actually use that as an additional point of leverage in transactions with the US. We can open up our economy to you, but if no one has any money to buy what you're offering, you're not actually going to get very much. But I think, again, case in point, we can increase our leverage by increasing domestic purchasing power. There's so many things that need to be done for that, including job creation. But the low-hanging fruit, I think, is a meaningful wage hike to expand immediately wages among our wage and salary workers.
And that empowers us. Buy local, in short. Thank you so much. Sunny Africa of Ibon Foundation. Appreciate your insights, as always. Philippine banks missed the mandated lending quota for small businesses again. Data from the Bangko Sentral showed loans granted by banks to micro, small, and medium enterprises amounted to 546.82 billion pesos as of March. That is equivalent to only roughly 4% of total loan portfolio of 11.82 trillion pesos. This fell short of the 10% overall requirement under the Magna Carta for MSMEs. Economists say this indicates a pessimistic economic outlook for MSMEs, which make them hesitant to borrow. Smart is now ramping up their 5G rollout nationwide. The digital giant is now preparing to bring their 5G Max to Visayas and other key areas in the country. This offers an enhanced 5G network experience with faster speeds, lower latency, and more seamless mobile experience. Last December, Smart introduced 5G Max in Taguig City. Smart Chief Operating Officer Anastasio Boy Martirez said their continued investments in 5G align with the government's push to boost digital competitiveness. Smart is encouraging customers to upgrade both devices and SIM cards. Subscribers can easily check if their SIM is 5G ready by texting SIMcheck to 5832 for free. And that is it for Money Talks. I'm Cathy Yang. Catch us again tomorrow, 9:30 a.m. here on One News. We're also streamed live on YouTube and on our Facebook channels. Have a great day ahead.